Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining me today is Natalie Garcia, Managing Director and Head of Underwriting at Deerpath Capital Management. Natalie, it's a pleasure to meet you. Thank you for your time. I'm looking forward to the conversation. How are you doing today?
I'm doing well, thank you. And thank you, Todd. I appreciate the opportunity to be on your podcast.
So, just to kick off, I know that we've had a pretty volatile year here in the U.S. We've had tariffs, potential trade wars, recession fears. How do you think of these various events and how they factor into underwriting, and has strategy shifted at all amongst all the volatility that we've seen so far?
Has it been a volatile year? I don't really know what you're talking about. Just kidding, of course. Yes, lots of uncertainty in the world, a lot of volatility in the macro environment between tariffs, recessions, legislative changes, et cetera. But there hasn't really been much of a change in our underwriting since we've always focused on US-based companies that have recession resilient characteristics. And we've always underwritten to more conservative structures from both leverage and interest coverage. Our portfolio is primarily constructed of US service-based businesses that offer kind of basic, everyday, commonplace services to US businesses and consumers. So think about the eye doctor or the company that repairs your air conditioning. So from a tariff perspective, our portfolio is fairly insulated from tariffs, and any services that our borrowers offer that involve an imported component will be passed on to the consumer. To your question on the recession, we mostly lend to businesses that have long operating histories of 20 plus years. They've withstood the COVID pandemic and other recessions. So we feel good about their ability to sustain a recession. And additionally, we have conservative loan structures in our portfolio, which provide cushion in a downturn. We obviously run multiple sensitivities in our underwriting and cases to see if companies can still service their debt in a downturn.
So your role is MD and head of underwriting. Kind of what falls under that remit, and maybe throughout that answer, what does Deerpath look like today?
Yeah. So I'm head of underwriting, as you said. I also am a permanent member of our investment committee, and I manage a team of 15 individuals who are exclusively focused on underwriting. My team is responsible for conducting due diligence on borrowers, recommending capital structures, identifying the key risks and strengths of a deal, preparing a lot of analyses that summarizes all aspects of the businesses and shows multiple sensitivities. And then we also oversee the legal documentation negotiations and any further add-ons or upsizes in the financings. So Deerpath, we focus on the same strategy since our inception. We've been in the market for 18 years. We focus on the senior direct lending market, specifically on sponsor-based businesses in the lower middle market. We manage $8.5 billion of assets under management, and we have over 100 employees with 5 offices in the US and fundraising offices abroad. From a deal perspective, we source 2,000 plus deals a year, and we've closed on 1,100 in our history. And then 2 years ago, we entered into a strategic partnership with Prudential Investment Management that's been very complimentary for us.
You've referenced a couple of times in your answers, obviously the senior secured and conservative structures. How do you determine kind of that optimal balance between yield and protection?
Yeah, so we have a safety first approach, and we offer our investors stability and consistent yield. So we don't compromise on protections. The structures need to work for us. We need to be in the senior first lien position. We need to be at a comfortable leverage level. We need to have ample interest coverage. We absolutely need to have covenants in our deals, information rights, and cash paying interests. So we will compete on price, on yield, and we will also offer growth facilities to our borrowers, and customize some of our facilities to meet the borrower's needs. But it's very important to us that we don't compromise on our protections. And this is where our strong originations platform comes in, because we're able to source 2,000 deals in a year, which enables us to be very picky and walk away from these deals that don't meet our criteria for protections.
So interest rates have had a moment the last couple of years. How have obviously we're in a higher for longer, at least for the moment, period. How have the higher for longer affected debt service capability amongst the lower middle market borrower?
Yeah, so this change has already made its way through the portfolios. Interest coverage has tightened over the past 2 to 3 years. And I'd say across the core middle market, interest coverage is in that 1.5 times range. And you're seeing an uptick in PIK interest. In the lower middle market, because the loan structures tend to be more conservative, you're seeing coverage in the kind of 2 to 3 times range, interest coverage. And I'd say that in a higher interest rate environment, we've seen when there are covenant defaults, that they tend to be more fixed charge coverage ratio defaults on the covenant trip. And then in response to that, sponsors are being careful about preserving liquidity in their businesses, and they're injecting equity into their businesses.
I know someone who wants obviously a lot of rate cuts, but what would a rate cut mean? In the market, which everyone seemingly is expecting at least sometime this year. What would it mean for direct lenders? What would it mean for Deerpath?
Yeah, it can mean several things. I mean, more broadly, we'd expect to see more confidence in the market and a rise in M&A and deal activity. Additionally, you'd see less of these liquidity pressures on businesses. Um, on the flip side, I would also expect that you'd see more of an uptick in leverage, and the leverage levels that are being requested from borrowers, because they'll have the ability to service a higher debt quantum. So I think it'll be, both an uptick in activity as well as potentially an increase in leverage levels.
And are you seeing changes in loan demand as companies kind of adjust to the tighter credit conditions?
It's still a relatively competitive market because of the supply demand imbalance in the market. So because M&A activity has been quieter and there is a lot of capital in the market, you are still seeing relatively competitive terms. I'd say our sponsors aren't pushing the envelope on leverage levels, but they are asking for, competitive pricing and then other competitive terms.
So when thinking, kind of more broadly about the lower middle market, what sectors, do you think and have you seen be most resilient to maybe some of the headwinds and which ones ultimately are most vulnerable?
Yeah, so I would say that these mission critical service-based businesses that compete in their kind of local regional markets will continue to be resilient. So if you think about IT services, the company that makes sure that everybody at Deerpath has a computer and access to the shared drive and cybersecurity training, those businesses will be resilient. Business services as well. Healthcare services will also be resilient sectors. Like just as an example, I live in Florida, and if my car is not working, I'm going to pay to get it fixed.
Yeah.
I need to drive to work. And if my AC isn't broken, well, that's the first thing that I'm going to get fixed. And I still go to the dermatologist 2 times a year, if we're in a recessionary environment. So these,
Yeah.
these are the sectors that we think will be resilient. The sectors that are more vulnerable are ones that are, more tied to discretionary consumer spending. These are nice to have versus need to have items. So consumer and retail businesses, as well as companies that have some exposure to tariff, we would expect those to be more volatile.
What about, I mean, just to follow up on that one, what about the AI, kind of potential impact on maybe some of those technology sectors? I mean, I've seen some others,
Yeah.
comment on LinkedIn and otherwise that, there's a lot of technology businesses that might not yet see the issue, but are going to come up against the growth of AI. I mean, do you see that as a potential area of vulnerability in the market?
Yes, absolutely. So in our underwriting, a question that has consistently come up over the last 2 years is, can these businesses be displaced by AI? There are sectors, such as like marketing services companies, like the accounting companies that do, accounting and taxes and prepare taxes for individuals like you and I. Those types of businesses, kind of language related or dictation related services, or e-discovery for law firms. Like, we think those are all areas that can be disrupted by AI, and it's a very important conversation that we have with our investment committee. So, I view that separate from, economic exposure, but absolutely, that's something that that will impact a lot of these businesses.
What trends are you seeing in covenant structuring within the broader private credit landscape, and in what ways are Deerpath kind of adapting to some of these broader changes?
Yeah, so we're still able to get covenants in all of our deals. We always have a leverage covenant in our deals, and I'd say that what we're seeing in the market is requests for what I would call cov light, where it's a flat covenant or a very wide covenant that doesn't delever over time, um, or a request for just one covenant. So, we've seen a drop in the fixed charge coverage ratio, which in today's environment with interest rates being so high, is probably one that a lot of lenders may forego. But you are seeing a lot of requests for more generous covenant cushions. And then in some cases, especially where you see larger upper and core middle market sponsors purchase an asset that's in the lower middle market, you'll see requests for no covenants at all. So, that's something that is in our DNA, to always have covenants, and real covenants that delever over time. So that's an area where we may not be as competitive if we're up against, other lenders that are just willing to do a cut loose deal.
Overall, would you say lenders are becoming more selective about sponsor backed versus independent borrower deals in the current environment? And kind of, I guess, to add on to that question is, does any of that shift if we start dropping rates in the next handful of cycles?
So I think it depends on what the firm's mandate is, because it does take a lot of effort to build an origination and sourcing channel.
Yeah.
So from a deal volume perspective, in today's environment, where M&A volume, over the past few years has been a little bit quieter, for lenders that have both a sponsored and non-sponsored focused, I could see more of a shift towards the non-sponsored businesses, just regular businesses that are looking for financing for for whatever the purpose may be. So, and then for us, we exclusively focus on sponsor-based businesses. I don't think that the strategy will shift much with a change in interest rates, because I think it really has to do with your deal sourcing and differentiation. I think from a new entrance perspective, a lot of lenders are seeing, and investors are seeing, the value in sponsor-backed lending. But it is challenging to build an originations platform from inception. I mean, we've been in the market for 18 years. A lot of PE funds have their preferred lenders. So if you're not able to kind of penetrate that channel, then you may go to the non-sponsored independent company channel.
How does Deerpath deliver customized facilities tailored to sponsors and borrowers? And then where does that demand, come from in terms of the customization? Is it the sponsor or the borrower that's kind of, demanding that more?
Yeah, so it's typically the sponsor. So we primarily customize our loans, and one of our competitive advantages is that we can grow with our facilities. So we'll add what's called a delayed draw term loan, so a growth facility that will help these PE companies with their buy and build strategies. Most of the sponsors that we work with have a growth strategy via M&A. So we'll provide alongside our loan, a sizable committed facility that will allow them to grow and have that committed level of financing from the beginning. And then additionally, there's other sectors that may have nuances to their business. So there are some companies that require bonding exposure to grow, to bid on new contracts. Or there are sponsors that are buying businesses, but they don't want to own the real estate, so they want the flexibility to do sale leaseback transactions. So we'll customize our facilities to allow for some of these items, in a controlled and limited capacity.
How has Deerpath, monitor portfolio companies post close and make sure they're identifying warning signals and opportunities for covenant waivers or extensions? What does it look like post close?
Yeah, so we're very active with portfolio management. So the original deal team that underwrites the credit stays on the credit. And then on top of that, we have a team called our portfolio reporting and analysis team that also joins the deal team. So between these, the original deal team and the PR&A team, the PR&A team is compiling monthly financials. They're reviewing all the covenant compliance certificates. They're reviewing trends in the portfolio. So, like as an example, when all this tariff news came out, did a deep dive into which sectors within our portfolio could be exposed to tariffs. If there's a hurricane in Florida, we reach out to all the companies that are based in Florida. So we're very active in that, and we think that a company will always trip a covenant before they miss a payment. And before they trip a covenant, if you have monthly financials, you can see that downward trend and that they're going to trip that covenant. So that enables us to be proactive. We reach out to the sponsor and the management team, and we start the conversation early of, hey, the business looks like it's deteriorating, what corrective actions are being taken.
And are you guys unique in terms of, the two teams that you had mentioned in terms of the original underwriting team still staying involved? Is that a unique part of what Deerpath offers?
I don't know a lot of other lenders that have that kind of bifurcation between um, underwriting and also have an additional portfolio reporting and analysis team. We view that as a strength in our monitoring, because you have the original deal team that obviously underwrote the deal, and then you
Yeah.
also have another team that's helping with like the reporting and the monitoring and looking at trends in the portfolio.
We touched on it a little bit earlier, but there's obviously been a lot of chatter about, a potential recession. Um, some believe it might be sector, others more broad based. I mean, how does the preparation, excuse me, begin on looking at scenarios, and how far out do these scenarios go when it comes to, potential recessions, and kind of how does Deerpath prep for these types of incidents?
Yeah, that's a great question. From the beginning, in our sector selection and our borrower selection, so we look for borrowers and sectors that we think are resilient. We look for borrowers that have been through the financial recessions, and then also in our structuring by having a conservative leverage level and good interest coverage. The company's better prepared to withstand a shock in a recessionary environment. We also have, loan documentation with strong protections, and then additionally portfolio management. So all of these items help us prepare for a recessionary case. We do run multiple downside cases in each of our deals. We have a stagflation case in the deals that we underwrite, and then we have a fairly draconian downside case where we project a meaningful recession, and we assess the company's ability to service its debt at that stage, and then we assess the enterprise value cushion that's left in that stage. And then I'd say additionally, we're also very careful in the sponsors that we work with. We choose to work with sponsors that have a history of supporting their companies. These are sponsors that are typically on their second, third, fourth fund, have demonstrated a history of being able to raise capital, and also ones that have dry powder in their portfolios so that they can support their businesses.
I guess as an aside question that kind of just popped in my head, you mentioned, you guys look at about 2,000 deals a year. Obviously, you're being pretty selective on that. Of the ones you say no to, do they come back around the next year or the next year and see if it's a fit then as their businesses grow? Or is it, do you make that selection and that's the selection, and then you just, continue to look through your deal sourcing and origination channels for new opportunities?
Yeah, so a lot of the most of those deals end up being desk kills, right? So we actively pursue and discuss and work on maybe 15% of those. So it kind of depends on the reason why they were desk kills. If it's an industry that we just don't like,
Yeah.
that we think has unattractive characteristics, if that one comes back, it'll be a kill as well. If it's a business that has like this has come up a few times where it's companies that have put together through a buy and build strategy multiple businesses, and they haven't operated as one company and integrated yet. So we view that as like an integration and kind of management risk.
Mhm.
So if it comes back to us 2 years later and it shows that the integration has been successful and that the management team is strong, then that's one that we would certainly give a look, assuming that all the other characteristics are favorable. Or if it's a company that had a large customer concentration and then subsequently has acquired other businesses and that customer concentration has gone down significantly, then we'll take another look at that company.
Interesting. So one topic that has clearly been, I guess quiet for quite some time, it feels like, is M&A activity. Everyone says it's coming back, and who knows when. But how are you positioning your team and or your underwriting framework for kind of the supposed upcoming wave that's coming?
So I've told everyone on my team to take a nice long vacation this summer because we're going to get busy. But no, but in all seriousness, my team is well staffed for the activity for an uptick in M&A volume. And if we need more manpower, we'll hire more people. But I would say from our process perspective, there's nothing that we need to change on that aspect. Again, we've been in the market for 18 years. I've been working at Deerpath for 10 years. So we've had 2021 and the beginning of 2022 that were exceptionally busy M&A years. We got through that. So we feel comfortable that if there's an uptick in activity that we can respond to that, and if we need to add some additional people to the team, we'll do that.
One final question before we jump into the fun questions before we wrap up in a few minutes. We touched on AI a little bit before and kind of the risk it shows to current technology or current businesses that might be impacted by AI. But it's impacting a lot of businesses across the board. How do you guys think of the potential impact on the broader lower middle market, and then even on your own business, on underwriting or monitoring or automation of current businesses? Like, how do you view the potential impact both inside and out of AI, and how it might enhance or impact your business?
Yeah, so from a deal perspective, we do think that it's going to fundamentally change a lot of sectors, and we're very cautious in our underwriting to make
Yeah.
sure that we're not looking at sectors that we think can be disrupted from AI. From a Deerpath perspective, we do think that it's a very valuable tool that we're using and would like to use to enhance a lot of our processes and kind of streamline items. So I think it's a tool that can help us in our diligence with certain processes. It can take large sums of data and kind of standardize some of that data or summarize some of it. And from a legal documentation perspective, it can also help kind of search across a lot of our legal docs to see what terms we've agreed to, et cetera. We haven't implemented a lot of these today, but we are slowly adopting and getting smarter on which tools we can use from an AI perspective. I'll give you one example of how it's been helpful in our diligence. We were analyzing a business that its customers were pharmaceutical companies, and we had a very long list of customers. And we wanted to know which of these pharmaceutical companies are publicly traded, which of them are of a certain scale, and then which of them currently have drugs that are going through the FDA approval process. So taking that large customer list and utilizing AI, we were at least able to figure out which ones were publicly traded very easily, and then which ones had market caps above a certain size. So it is a very useful tool for for getting through a lot of data that otherwise would have been a very manual process.
So we have just a few minutes left. I like to end a little bit less in the weeds of credit. And so first fun question is favorite sports team and or hobby?
So from a sports team, I like watching soccer and tennis. So my favorite soccer team is Real Madrid, Los Blancos. And I've recently gotten into the Premier League as well. So Arsenal is my Premier League team. And then from a tennis perspective, I'm all team Alcaraz and Sabalenka. And then from a hobby perspective, the sport that I love to play, and that's kind of a recent obsession of mine, is paddle or padel. I don't know if you're familiar with it.
Never heard of it. I have to know what this is.
Yeah, so I say it's a hybrid of tennis and squash. It's a doubles game. It's very social, and I was an earlier adopter to the sport, so I've been playing it for 4 or 5 years now. So I'm a decent. I wouldn't say I'm a good tennis player, but I'm a decent one. And being an early adopter to padel, I'm writing a fading moment where I'm decent and being asked to play with people before it gets a lot more popular, and then I just become, a lower level. So that's what I do as a hobby.
Interesting. Yeah, I've heard of, certainly pickleball has taken off, but I haven't heard of this version of kind of the tennis sphere of sports. So,
Yeah.
one surprising thing about yourself, other than obviously what you just told us.
Yeah. So I'm born and raised in Miami, and I live there. And I know that there's a lot of stereotypes about Miami, but one maybe less known is that it's a bit of a kind of Jurassic Park situation when it comes to our wildlife. So kind of a surprising thing about me, despite appearing cosmopolitan, I do my fair share of, standoffs with peacocks and chasing iguanas and other animals on a pretty regular basis. I think most people are surprised to hear that.
Most exciting part of your job.
Yeah. So we're generalists at Deerpath. So we review all kinds of deals. And this is one thing that I find very exciting and interesting about my job. Because if you think about your day-to-day life, we're looking at day-to-day businesses that run, and contribute to the US economy. So if I think about my day, I go to the gym, I drive my car off to be repaired, I get a car wash, I go to eat at a restaurant chain. I see my eye doctor for my prescriptions. Like I've evaluated and underwritten all of these sectors, which I find very interesting. Just because as you go through your day to day life, you think about how these businesses run and your consumer experience and everything like that. So that's one of the most exciting parts of my job, just being exposed to so many industries and understanding how they run and operate.
And then final question is one prediction for the next 12 months.
Yeah, so this one I'll say kind of more specific to the direct lending market. I think the truth will come out about, whose portfolio is well constructed and who's kind of more resilient. There's been a lot of, extend and pretend. There's been a lot of pick interest in the market. And not all defaults and portfolios are created equal. So I think the quality of underwriting and deal structuring will start to show in the next 12 months.
Well, Natalie, I appreciate you spending a few minutes with me here today. So thank you for your time, and continued success to you and the team at Deerpath. Thanks, and have a great weekend.
Thanks so much, Todd. I appreciate your time. Cheers.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.